The Consumer Price Index, or CPI, for the United States for the month of October was released. It came in at 2.6% year over year, meaning that, on average, consumer prices in the United States grew at a rate of 2.6% relative to October of 2023. This is a slight tick up in the inflation rate relative to the September 2024 data. There is already talk in the mainstream news that inflation is ticking up, with some even calling for an imminent second wave of inflation. Of course, one data point does not make a trend. In 2023, there were many ticks up in the inflation rate, but the overall trend since June of 2022 in inflation has objectively been to the downside. Inflation data is very important for traders because it has repercussions across financial markets. Inflation data from the US government impacts the Federal Reserve's decision-making process and interest rate policies. This data also affects how Treasury bond investors allocate their funds. These investors adjust their demand for US Treasury bonds based on inflation, which in turn impacts Treasury interest rates. These interest rates then influence the stock market and most other assets. So inflation data has a huge impact on financial markets. That's why looking at these inflation releases and how the market reacts is very important for traders. Following the recent inflation data release, US interest rates remained largely unchanged. This means the inflation number was around what investors expected, and so they didn't need to make big changes to their capital allocations. On the other hand, the stock market reacted very poorly to the reading. After having made a new all-time high following the US presidential election results, the S&P 500 reversed lower, dropping by over 2% following the inflation release. Now, we can see that the S&P 500 has recovered a bit recently, but the question remains, will a pickup in inflation derail the rally on the index? The reason we want to be paying close attention to the S&P 500 is because most US stocks are closely correlated to it. Giants like Nvidia, Tesla, Amazon, Microsoft, and Meta are all tied to the broader US stock market's performance. But it's not just stocks. Other assets, like cryptocurrencies, are correlated too. Bitcoin, Ethereum, and other altcoins thrive when the market is booming and struggle when it's down. So looking at the S&P 500 and whether inflation is ticking up or down is a very important part of a trader's strategy. Over the last 2 years, the downtrend in inflation since June of 2022 has been very bullish for the stock market. The S&P 500 actually bottomed shortly after inflation peaked, and as inflation has continued to fall, we've seen the S&P 500 continue to push higher. This pattern of disinflation benefiting the stock market isn't something new. Falling inflation rates, or disinflation periods, often drive markets higher. The reason is because lower inflation rates typically mean lower interest rates on US Treasury bonds, so a lower return on investment for holders of Treasury bonds. This makes investors more likely to allocate their capital to the stock market to get a better return on investment. For instance, in the mid-1980s, rapidly declining inflation coincided with a stock market surge. This led to one of the largest bull markets in history. Similarly, the disinflationary period from 1990 to 98 fueled another powerful bull market in stocks. These disinflationary bull markets are similar to what we've experienced over the last 2 years. And typically, when inflation starts to pick up after an extended disinflationary period, like in these instances right here, that can put an end to the bull markets. So you can understand why the stock market is quickly becoming nervous today when a bad inflation number is released. If the disinflation environment comes to an end with inflation picking back up, the stock market would likely reverse lower. One of the key driving forces necessary for this disinflationary environment to continue is for oil prices to continue declining. This is essentially a question of supply and demand. Currently, we have record levels of oil production in the United States. Since 2020, US oil production has risen by over 30%. This, coupled with a steady decline in global GDP growth, has contributed to the declining oil prices. Of course, this situation could change rapidly, but since June 2022, we've been in an environment where lower oil prices have been dragging down the inflation rate. Oil isn't the only driver of inflation, but it plays a big role. You can see from this chart that tracks oil prices on top of the inflation rate that they're very much correlated to one another. This is not just about oil impacting consumer spending and the price of gas at the pump. Oil impacts the production and transportation of goods, so rising oil prices often lead to increased prices across all items in the economy. As goods become more expensive, workers typically demand higher wages to maintain their standard of living. This creates a self-reinforcing cycle of inflation, with each factor influencing the others. So when oil prices rise, it often translates into broader inflation. That's why monitoring oil prices can be an effective way to gauge inflation trends in real time, because we have market data on oil prices every single day, compared to the monthly inflation prints that we get from governments. Today, oil prices are generally trending down. We can see that quite clearly by looking at its moving averages that are all pointing lower, with price making a series of lower highs and lower lows. If oil prices keep going down, like they have been since June 2022, it will help keep inflation low. This, in turn, will likely allow the stock market to keep going up, at least as long as the global economy isn't dragged into a recession. But if oil starts to move up and break above these moving averages, it could be a sign of a big reversal in inflation trends that would negatively impact the stock market. This is why, in this disinflationary market environment, it's very important to keep a close eye on these trends. We'll continue to provide updates on the assets we offer to trade at Capital.com, discussing any potential changes in market trends. Thanks for watching.